Good morning, everyone. I can see lots of people joining online. We'll just give everyone a couple of seconds to hit the join button and to settle in for the session. Welcome to this Clear investor briefing. Today we are joined by Andrew Smith, the CEO, joins us, Victor Pepler, the CFO, and Jason Serafino, the Chief Product and Technology Officer. As I said, thanks for joining us on what's a very busy day for investors, I'm sure. Yeah, for Credit Clear's first half 24 results, I'll hand over to Andrew Smith to take you through the presentation.
Thanks, Warwick, and welcome Jason and Victor. We're very, very proud of the result that we're presenting today. In fact, if there's three things that you're going to remember out of today's presentation, I'd want you to think about the fact that we're now generating cash from operating activities. We're consistently growing the business at sort of over 15% on prior corresponding period. And lastly, we continue to sign key clients that give us a long runway to future growth. So they're the three things really that I want to highlight today, as demonstrated by the upgraded guidance that we're going to give to the outlook. So as I said, the cash flow positive half, generating 1.6 million from cash from operating activities. The company is now growing sustainably, profitably, and generating free cash flow. This has resulted in Credit Clear upgrading our guidance from 39 to 41 million dollars in revenue to 40 to 42 million dollars in revenue, and guidance in terms of underlying EBITDA from 1 to 2 million to in excess of 3 million dollars. So just look at some of the improving key metrics that we look for in the business. As you'll see, we're all heading in the right direction, half on half. What we're seeing is consistent growth, delivering a 20.03 million dollar half year result, which was up 15% from prior corresponding period. 1.8 million dollars underlying EBITDA as well, significant improvement on prior corresponding period, and over 13 million dollars cash at bank, despite acquisitions of DRA in that period. So summary of the highlights, over 20 million dollars in revenue, once again up 15% on prior corresponding period. This is a key metric that all of our shareholders and fund managers and interested parties are really looking for, is that improvement in the underlying operating leverage. That's been demonstrated by 9% of underlying EBITDA margin to revenue. This is an improvement from 0% last year to 9% this year. So we're now seeing significant drop through to the bottom line on every new dollar of revenue that's being added. So that should give you confidence that this business is on a growth path, and that growth will continue to deliver underlying EBITDA. 1 million dollars statutory EBITDA, that's an increase of 5.4 million dollars improvement on prior corresponding period. So a huge uplift there, and 54% gross profit margin, up from 50% in the half in 2023, driven by digital collections, a combination of transferring old analog activities to digital, and an improvement of the software as a service sales. Once again, 1.8 million dollars underlying EBITDA. That's a huge improvement from last year, and 1.6 million dollars of cash from operating activities. I'm going to pass over to Victor now to go more into the financial detail.
Yeah, thanks, Andrew. And just an additional comment on the prior slide as well. You know, we're in a market at the moment where fundamentals, are important. So, I think we've achieved all of that through revenue growth, through EBITDA, flow through to the bottom line from revenue, margins, etc. And just to expand a little bit on cash, at bank, so on the balance sheet, very solid balance sheet there, which will allow us to take advantage of any future opportunities that may arise, similar to the DRA acquisition we completed only recently in November, which is already adding to our top and bottom lines, and cash is also cash flow positive. So just to highlight, we are achieving on a fundamental basis. So we go to the detail now. So I thought it'd be useful here just to compare the last three half-year periods, just to illustrate the transformation that the business has gone through over the last 18 months, rather than just compared to the PCP. And I'll start by focusing on underlying EBITDA. So the section there between the two green rows, we can see revenue, as Andrew has already mentioned, increased 15%. So what's interesting and pleasing is that revenue growth is coming from both new clients as well as existing. As far as new clients go, we're starting to establish ourselves as having a really good reputation in terms of service, dealing with debtor hardship, which is what our clients are looking for, as well as more superior collection rates compared to our competitors. And our digital capabilities also been a real positive in winning clients, and again, particularly the large clients that we refer to later as Tier 1, Tier 2. I think a lot of these clients are starting to see that the trend in the industry is to move to digital. There was a little bit of reluctance a couple of years ago, but they're starting to see the benefits. And maybe Jason will talk a little bit about that digital capability and the benefits we're achieving. Not to mention the client experience using digital collections. Okay, so we're still getting very high NPS scores, which is a measure of client experience. So that's certainly helping us get new clients on board. In terms of existing clients, we're seeing a number of clients increase their share of business with us. And again, it's either on the back of high collection rates, service, and a number of other things, including data security. We've invested in data security, so that's helping our clients, our existing clients, increase their business with us. So that's revenue. In terms of expenses, we've got employee benefits there, as you can see, down 2% on PCP. Despite the growth in business, we've managed to keep that slightly down. And it's important, I think, to remind just the audience here that we acquired Armour 2 years ago. We've gone through a transition period, which involved looking at the org chart, and we've made some changes there to through a very challenging transition period, but we've managed to, I think, optimize the return on employees through that period, and that's really coming through that line there. Tech development OPEX, this is the OPEX component. I itemize that separately because it's very much an important part of our business, as I've already mentioned. We maintain investment in tech dev there at $1 million. So that you can see, we're starting to get the returns on tech development, so we haven't lowered that at all.
Just to add on that, a big part of that tech development is in improving the speed of the onboarding process as we bring new clients on board or can deploy the software as a service. So it's very much improving our ability to monetize the technology quicker.
Yeah. And then we see other expenses there have increased slightly, as you'd expect, given the support in business growth and the investment in client acquisition and onboarding, as Andrew has just mentioned. So that takes total expenses to 18.2 million for the half, 5% increase on PCP. And the key message here, which is and you can see the flow-on effect there in the underlying EBITDA, improving from $51,000 loss to 1.7. And the key message here on this slide, I think, is that revenue has increased 15%, total expenses only 5%, and that's where we're achieving the operational leverage that we've spoken about for a couple of years now. But I think this is the first time that we've been able to report the results of what we've been aiming for and planning to achieve. So, revenue flowing from, the top line to the bottom line, combined with the economies of scale as we grow, is really improving that bottom line. And we've introduced a new measure here for this half, which is the EBITDA, underlying EBITDA as a percentage of revenue, which you can see there goes from 0% in the PCP half to 9%. And that really we believe validates our business model. The business model is working. We're starting to see that for the first time through the last half year. And, we're quietly confident that'll continue to improve as we grow the business. Just touching quickly on some of the other items which we do not consider to be non-core. We've got some revenue there relating to government training grants, which are phasing out. We've got expenses there which are, well, almost diminishing now, but they mainly relate to Armour acquisition and some legacy legal issues. The Armour earnout is no longer applicable, and we've got share-based expenses which are below underlying, particularly given the volatility you can see there from half on half on half. So we measure that there, and given everything I've just said, we see the flow through to statutory EBITDA, which improves from 4.3 loss in PCP half to almost $1 million profit, and then obviously the flow through to the bottom line there. So very pleasing in terms of improvement in financials over the last 18 months. We consider this to be a very good financial result for the half year, and we're quietly confident that we can continue to improve the business from a financial standpoint into the second half of the year, hence why we've upgraded our guidance on both the revenue line as well as underlying EBITDA. So overall, management's very pleased that we see this as the start of better things to come. So their financials, I'll now hand over to Jason.
Thanks a lot, Victor. It's great to see Victor looking so happy. Underlying these great financial results is our strategy to transform the experience of customers who are dealing with overdue debts. As we know, debt collection hasn't had the best reputation. I think whenever I'm at a party and tell people what I do, it immediately evokes images of guys with baseball bats, etc. But when you consider how costly it is to acquire new customers, it makes much more sense to rehabilitate and preserve customer loyalty. And today, so many Australians have experienced difficulty, be it COVID or cost of living pressures, and it really has become critical. So we felt we could transform the industry by bringing together a team in Armour that had been trained to provide a much better experience on a call, legal services in Oakbridge, plus the best digital solution on the market for the increasing number of people who don't want to speak to somebody about this embarrassing situation and just deal with it in the privacy of their own phone. In other words, better experience for all customers, regardless of how they want to be contacted, and solutions at every stage of the life cycle. So the organisations have come together really well, and we have some of the highlights here, which are phenomenal. As a result, it's pleasing to say we're doing exactly what we said we would do. In fact, as Andrew alluded to, doing better than. We've been winning clients at record levels. So Armour's tender win rate before acquisition was 30%, which was already great. And now it's risen to an unheard of 70%. And that's because large clients, all clients actually, but particularly the large ones, are increasingly focused on customer experience. And they're also particularly asking for digital. As Victor said, our largest new client coming on board came on expressly because of digital. And so that's really been putting us in the pole positions on tenders like never before. Clients signed in FY23 now achieve 76% of our revenue expectations. So we really couldn't be happier with the wins that we're getting in sales. And as Victor said, our gross profit at the same time is increasing from 50 to 54%. And this is reflective of both being able to consolidate systems across the organisation, but particularly the increasing proportion of customers who are choosing to self-serve on digital. That drives up GP because digital is 80% GP, but it also means that we can rapidly scale, as you're seeing in the numbers. And as we continue to invest in the digital platform, we're able to cater for more and more circumstances where customers can deal with these more complex circumstances digitally, and we can expect to see that GP continue to improve. So lots of green ticks, not only doing what we said we would, but actually upgrading guidance for the year, which is a wonderful place to be. So in summary, we're winning record clients. Once we win them, we're outperforming our competitors. We have a great team and we have amazing digital technology. And frankly, we've left the competitors, they've been caught short, actually. They didn't see the impact that digital could have. And we are years ahead of them in terms of investment in digital, in our digital platform. At the same time, we're expanding our profit margins. And now we have a proven record in terms of being able to integrate acquisitions. The latest one, DRA, immediately contributing to 1.2 million in revenue and 300,000 earnings, which is paving the way for other opportunities.
Yeah, just on that DRA acquisition, there was only, you know, $200,000 worth of revenue and $50,000 worth of earnings that sort of dropped into half one of 24. So what we'll see in the coming halves and quarters is that contributing a larger proportion of our revenue and EBITDA.
That's over to you, Andrew.
Yep. So I'm going to start to talk about some of the outlook. As an executive team and a board, we thought long and hard about looking at the business and where we could cut costs. And the areas that we looked at were areas that weren't necessarily delivering immediate value to us right then at the time, but would deliver future value. And that was in the area of sales and marketing and investment into digital. And we stood strong behind our strategy that, you know, investing now for future growth and future success was what we needed to stay strong with. And I'm really proud of the fact that we did that, because we're now starting to not only see the benefits to our existing client base, but it's showing in the future leading indicators. And these are some of them. So $2.2 billion of value of the files under management. That's an extraordinary increase up on half. Having 1.3 million active customers under management. I mean, I think about the proportion of customers that, you know, have an overdue debt across Australia, and I think we're touching a large majority of those. And this indicator of 225 new clients acquired in this particular half compared to 182 last half shows that momentum that's been generated from the sales and marketing efforts of the team. And whilst this is a great result and it shows a pivotal change in the financial discipline of the business, and now we're starting to get that operational leverage, and each dollar that we're adding to the bottom line is generating over 50% EBITDA. We can be confident that that's going to continue in the future on these metrics. So, I mean, that's certainly hopefully give a bit of a better outlook. And the next slide we look at, we'll talk about just in terms of what new business we've brought into you know, Credit Clear Group and how that's impacting. So, having 16 tier 1 clients up from 12 not only highlights the fact that we're not, you know, dependent on one large key client for anything more than 5% of our revenue. So we haven't got really key client risk. You know, should one client, you know, decide that they're going to completely change their strategy, potentially do some stuff internally. What we're seeing is that the diversification of clients across varying industry, whether that be banking, finance, utilities, telco, government, what we're seeing is those key clients and tier 1 clients are spread across, and we're increasing those key clients from 12 to 16. And a key client, you know, delivers an average of $1.1 million of annualized revenue from us. So, you know, the largest key client we signed is delivering an annualized revenue of 3.1 million. All right. The reason why we've got the tier 2 clients there is it just shows we've got a large number of clients just sitting below those tier 1s that could be future tier 1 clients. So seeing that increase significantly year on year, half on half, and delivering an average income of 180K per year is just a really good source of future growth as well. So once again, creating a lower risk because of the broad spectrum of clients across multiple industries and multiple key clients, really gives the company robustness and strength. Once again, I look to the future. There's a number of key clients that we've signed, and in fact, tier one clients that we envisage and are forecasting to become key clients. Two of them did not generate any revenue yet in the last 6 months, but in fact had started to generate revenue in January and February. So we'll see them in future results as key clients. 3 are in the process of being onboarding. So if we think about the previous half having 16 tier one clients and looking to increase that to over 20 or 21 tier one clients, we're really confident that not only our outlook is looking very strong, the point to the right is that we've increased our guidance to reflect that confidence in the business momentum. Here's just an illustrative diagram, once again, that looks at the life cycle of typically a tier one client, occasionally a tier two client, where there's a 3-month worth of onboarding, typically sometimes a 3 to 6 months, where we'll look at initial portfolios. We look at optimizing those portfolios. And then once you get beyond that 9 months, you really see the profitability increase, where we'll increase the share of work that we're getting across that client and typically outperform our competition and get a larger share of the portfolio. The encouraging thing that we're seeing through the great work that the tech team is doing is that we've been able to shrink and shorten that onboarding time. And in fact, one of the tier one clients that we've signed that went live in January, the onboarding time for that was only 4 weeks. So having been able to reduce that from 3 months to 4 weeks was quite extraordinary. And we're looking to continue shortening that period, which once again will deliver revenue and earnings from those clients quicker and reduce the cost of onboarding, once again driving up profitability. So some really good news to share there as well. So once again, we get to the outlook. I think there are definitely macroeconomic tailwinds that are in our favour. What we're seeing is a lot of clients and their customers experience challenges in dealing with overdue accounts, and Credit Clear has really established ourselves as a subject matter expert in that space, and they're coming to us as existing clients or new clients to assist in that area. I think there's still some deterioration to occur in the economy. I don't think we've seen necessarily the worst of inflation and interest rate rises hit the economy. There's still a number of mortgages that are on fixed term interests that are going to come off, and that immediate whack in terms of cash flow impact to the household will certainly have an impact. So we're preparing to help and assist our clients through that period. As I've talked about, this organic growth continues as clients really look to Credit Clear as a good option or a solution to manage their way through a collections increase. What we're seeing again is strong potential for margin growth as we manage our cost base at a level that's not increasing anything like our revenue is increasing. And based on our expectations, we've been able to increase guidance, once again repeating myself, of $39 to $41 million in revenue to $40 to $42 million in revenue, and underlying EBITDA guidance from $1 to $2 million to in excess of $3 million. So once again, we're a company that hopefully is starting to get a reputation of potentially under-promising and over-delivering rather than historically over-promising.
Thanks very much, Andrew. Certainly, I think in a very good spot now. I'll invite the attendees to submit their questions in writing if you can. There's a Q&A panel at the bottom of the Zoom screen. If you just hit that button, you can submit any question that you have in writing, and I'll put them to our three presenters. Maybe just to kick off with a question from Susan. Victor, you mentioned data security and some investment going into the data security space. Could you just perhaps expand on that, and then Jason maybe expand on the work itself?
Look, I'll talk from a financial perspective, but Jason's better qualified to go into the detail. Look, it's an area that is obviously topical. We've seen other companies, been hacked into. Data is important for our clients. Our clients, in considering whether to do business with us, have certainly increased their focus on our levels of data security, and we anticipated this. We allowed for it in the budget, so we've certainly invested, material amounts. So that's a financial aspect, but I'll hand to Jason to talk more about the technical aspects.
Yeah, thanks, Victor. All clients, as you say, are very, very focused in this space, and they're looking for a safe pair of hands. And so as a leader in the space, it's really helped us. We've become very, very good at doing very significant due diligences. But to answer your question specifically, we have the highest standards of data security, ISO 27001 certified with DSS, Tier 1 certified. So we can show clients that we have a very, very high standard. We can tick all the boxes they're looking for us to tick in terms of due diligence, and we've really built the organization from the ground up as a security first organization, which is very much music to their ears in the current environment.
Thanks, Jason. A question from Anonymous. We don't normally take anonymous questions, but might as well. A few months ago, we were optimistic of signing further Big Four banks. Any updates regarding work with the Big Four? Andrew?
Yeah, look, we've completed a 9-month due diligence process and onboarding process for one of the Big Four banks, and that should go live any week now, which is fantastic. So they're very much at the end of that onboarding sales process. And I mean, the exciting part is that we're in an active sales process with 2 other Big Four banks, and looking to onboard them as quickly as possible. I would just want to caveat that by saying it takes a long time from start to finish. Nothing really happens quickly at a bank, especially when you're dealing with such large integration and implementations, and large compliance teams, and sometimes slow moving teams in terms of deployment. So it's not just about us being able to do our component of the onboarding, but also about it being a priority for the bank. But we are certainly in processes with 2 other major Big Four banks, and it gives us a long runway in terms of future growth as well.
Very good, very exciting. A question about for Victor, just on non-core items. Victor, any idea on when we sort of where we land in terms of EBITDA positivity, including those non-core items?
Yeah, well, we are. Maybe if we're already EBITDA positive for this half just gone. Maybe just go back to slide 10, Warwick, and I'll explain. So as we can see there, the first yellow row there, that's the statutory EBITDA line, whereby we've reported 974,000 positive. That's a profit there. Unless the question is directed towards the very bottom line, net profit loss. To convert that $2 million loss to a positive, assuming 50% gross margins, we need an additional $4 million. This is for a half, so 20 million would be 24 million for a half, annualized at $48 million. Based on recent run rates, I'd like to think we can get to $48 million in FY25, all things remaining constant. And that's what we'll certainly aim for. But that's how I see it as it stands today.
Thanks, Victor. A question about acquisitions, perhaps for Andrew. What's the industry mood at the moment, Andrew, regarding sort of consolidation and opportunities that might be out there?
Yeah, look, it's really interesting, and one of the points I was going to make during my presentation, there's still consolidation within the industry at the very top end of our competitors, which has given a better opportunity for us to sort of step up to be appointed on a panel with, say, a big bank or a utility company. But there's also lots and lots of smaller, businesses, whether they be technology businesses that process payments, or whether it be small debt collection agencies like a DRA that are absolutely ready to be acquired. I mean, we've got $30 million in the bank. We want to make sure we're using that to grow the business, not just organically, but through acquisition. And it's very much part of our core strategy of achieving our goals. So the great part about the DRA acquisition was that it's been able to integrate and immediately start delivering earnings from day one. And from a cultural perspective, they were like me when I was at Armour, really understood the need to digitize their business to stay relevant in the market. So there is lots of organizations out there that recognize that, the future is going to be digital collections. And whilst there's always going to be a place for, people in a call center taking overflow calls from those individuals that need to speak to someone about financial hardship or about, an issue they might have with the accounts, the majority of the work in the future is going to be done through digital engagement. So that means we've got a very good pitch to those smaller agencies or to those businesses that want to come and join us on that journey of digital transformation. So very much it's in our strategy. It is very much within the Australasian market at the moment. But we can't not look at other markets like the US or Europe in the near future.
There was a question leading to international expansion, so I think you've addressed that there. Thanks for that. A question just on the macroeconomic environment. What are we seeing from clients and their customers at the moment? We did prepare a slide that went into the appendix, but just generally on the macro environment, Andrew.
Yeah, just back on international expansion. 2 years ago when we got the businesses together and we're looking internationally, I feel like we hadn't quite earned the right to look internationally and got the financial discipline within our Australian operations to allow us to, self-fund investigations internationally and look to invest costs into a market that wasn't going to necessarily deliver earnings or growth straight away. So we're now in a position where we've earned that right, and we can start to look beyond our current markets to those, larger markets that we can now deploy software as a service confidently and efficiently. So that's very much in the strategy moving forward. Coming back to the question about the economic or macroeconomic conditions, we're still seeing it as very favourable for Credit Clear as a group. That being said, Credit Clear is really, robust in terms of being strong in most economic conditions. And where we start to push upstream in terms of early collections, software as a service, integrated within our clients' core CRM systems, that gives us the opportunity to be completely resistant to all economic conditions, because everyone's going to have credit, everyone's going to have a need for reminders. And what we're seeing now that we've established ourselves with lots of major clients at late stage overdue debt collection, it makes it so much easier for us to provide case studies on their client data to show that we can upsell the software as a service. So, back to the economic conditions, certainly very favorable right now for us, and gives us the ability to go and start a conversation with a new client or elevate the level of work we do with existing clients.
Thanks for that. Tony's asked a question about artificial intelligence and how the development of artificial intelligence is impacting Credit Clear and our clients. Jason?
No, thanks for the question. It's great to hear AI on the tops of everybody's minds. Obviously we've had a big footprint into this for many years now, and so it's great to see kind of, if you like, the market kind of catching up in terms of the capabilities. So yeah, for Credit Clear, I mean, I would say to anybody about AI, it's really a data game. It's really about having the right data and a volume of data. And so we're very privileged to have been doing this for a lot of years and hitting some really good volumes. 1.1 odd million customers on the platform provides a huge amount of data for us to analyze what's going on. And that's what's driving AI. We're also in a great situation. Organizations that have a volume of data often can't pull it together. They can't wrangle it into the right form to be able to do something with it. So we've had multi-year investment in building out a very sophisticated data platform to allow us to do that. So today, AI to us is about the right channel, the right timing, and the right message to engage customers, where we've seen fantastic uplifts, the order of 20 to 30%, and won awards for the best AI in fintech multiple years running. Where we're interested in going at the moment, I'm really interested in we're doing a lot in the vulnerability and hardship space. And what we might mean by that isn't the old world of hardship where a customer declared hardship and they had to fill out this horrible form, multi-page form with all their assets and liabilities to get through a process. We're actually talking about streamlining and making that process a wonderful customer experience, but extending it to be flexibility for all customers, because we all need a bit of help sometime. And I think AI's got some really interesting places that it can play in there for coming up with the right payment frequencies or the right kind of arrangements for a particular customer, and then helping monitor them and provide guidance to them about how to stay on track. So we're going to be we're focusing a lot in that space at the moment.
Thanks, Jason. I'll just return to this slide. We've had a question about client stickiness, Andrew, and the question following that was about insurance, and insurers are some of our biggest clients and some of our stickiest clients. So let's deal with those at once.
I'll try to answer both. I mean, as you'll see from this slide, 44% of our revenue comes from tier 1 clients. And all I can say is in the 2 years that, I've been CEO of the group, we've not lost a tier 1 client. So that's something we're very proud of, not just in terms of the stickiness of the business, but that's delivered through a couple of things. One is the performance in terms of the success we have delivering better financial returns to the client, the compliance associated with the systems and processes we have around support and ensure that the privacy and the treatment of those customers are very strong. And certainly lastly, in terms of the net promoter scores that we can demonstrate at a client by client level, that shows that not only are we doing a better job at collecting overdue debts, we're doing a better job at managing the experience by, I think it's something like over 60 or 70% of the clients or end customers giving us a 9 or 10 rating for the experience. So, coming back to your ongoing reoccurring revenue model, it's one of the things that we want to try to share and look at the last 6 months and what 6 months those key clients delivered. But as you blend in new business, it's sort of harder to measure that reoccurring revenue from the key clients when we are adding so much new business to the baseline. Just shifting to the insurance question, that's certainly an area within the core competencies of Credit Clear, not just as a digital agency, but also as a traditional agency that both Armour and Credit Clear had huge strengths in. So we certainly work with the 2 largest insurers in the country on both fronts, from a digital software as a service basis, but also as a late stage collection space. And both those customers are extremely pleased with how we're performing for them. And that naturally builds momentum as you move into other smaller insurers, and we continue to sign new business. And in fact, hopefully you can watch this space. We'll get approval from key clients to start announcing some wins in this space that have signed, have been onboarded, and we've started to see some revenue from this half.
If I can just maybe add to that, Andrew, on the insurance side of things. We just struck our partnership with Guidewire is one of the largest claims and processing platform providers in the market, to add the digital as a plug-in to Guidewire. And we've been working with Guidewire with some of our major clients for quite some time. So it's another channel to market, an exciting way of getting our product out there.
Yep.
There we go, Robert. I hope that answers your question about the Guidewire partnership. Maybe just one more question from Susan, going back to AI and the vulnerability hardship space. How do those two things come together, Jason?
So yeah, I think I'm just looking at your question there, Susan. Yeah, so yes, in terms of predicting, people who might be getting themselves into trouble, but also, so we've actually got some really interesting work that we've been doing on that, which is obviously very exciting. But also in terms of helping people get out of that trouble, there's some really interesting analytics that we've done about, what is the right kind of plan for this particular person to get themselves out of trouble. A higher payment gets them out of trouble faster, and that can be a good thing. But then obviously they've got to bear that higher payment. A small payment of a very long period of time can actually be disadvantageous to somebody to actually get themselves out of trouble. So looking at all of that with them is the kind of thing that we've seen some very interesting predictive capabilities in our platform.
Thanks very much. Just before I hand back to Andrew to conclude, we will send a recording of this presentation around to all shareholders, and we'll pop it up on YouTube as well. If you want to go over anything, always happy to receive questions from any interested shareholders or investors. So please email any further questions directly through to me. We'll look to answer them. Andrew, to wrap up.
Yeah, look, just to wrap things up, very proud of the team and the results that have been delivered, and incredibly optimistic about the outlook moving forward. I think we've broken the back of the change in the business. There's an inflection point that's happened. We're now generating cash from operating activities. We're now sort of at that point where we've got that operational leverage, where as we grow, our expenses aren't going to grow at the same level of our revenue. So that's what I seem to get asked on a regular basis in most of my investor meetings, and that's something that hopefully will give the market confidence moving forward, that Credit Clear is certainly got a hybrid offering, leveraging SaaS, leveraging traditional, leveraging legal, and that is something that's being taken up at a very high level from the market. So thanks for everyone for your time and patience on the call. We covered a lot, and I know it's a very busy week, so I appreciate your time.
Thanks very much.
Thank you.
Thank you.